All right, let's initiate the boot sequence and dive right in. Today, we are pulling back the curtain on something truly fascinating. We're looking at a complex, multi-agent large language model trading simulation that's evaluating PayPal, ticker symbol PYPL. Imagine this as a live playback of a high-tech financial matrix. We've got distinct AI agents processing incredibly dense market data, and they're arguing, debating, and ultimately synthesizing a concrete trading strategy. We're going to visualize their exact outputs as they flow through this simulated neural network. Here's our roadmap for this explainer. First, an AI trading simulation overview. Next, a fundamental valuation breakdown, followed by a strict technical indicator checklist. After that, we'll synthesize bull versus bear arguments, deconstruct the internal agent debate, and finally, extract an actionable trade execution plan. Let's get to it.
Section 1, AI Trading Simulation Overview, Inside the Neural Net.
Take a look at this live feed from the dashboard interface. If you check out the left side under the agent status, you can see exactly how these LLM agent teams are structured. We've got the analyst team out there crunching market, social, and fundamental data. We have the research team splitting into dedicated bull and bear researchers. And then we have the risk management agents, categorized as aggressive, conservative, and neutral, all being overseen by a portfolio manager. They are processing a massive complex web of PayPal data in real time, working together to formulate a strategy. Moving on to Section 2, Fundamental Valuation Breakdown, the engine room. The simulation immediately flags this number, an 8.72 trailing 12-month PE ratio. This establishes the absolute base bullish reality for the fundamental agent. PayPal is generating real cash, but it's trading at a multiple that is fundamentally inexpensive, especially when you compare it to its high-growth fintech peers. The market is pricing it for limited growth, heavily discounting it against its historical highs. It forces the agents to ask, is this still a premium franchise or just a value opportunity? Then the neural net spits out this output, a 25.7% return on equity. At first glance, this looks incredibly strong. For a mature, cash-generative platform, producing a nearly 26% return on equity screams operational efficiency. But hold on, because the fundamental agent flags a massive caveat here, and we need to unpack this crucial nuance. If we step back and look at this like a skeptical auditor, that 25.7% ROE isn't purely operational excellence, it is artificially inflated. How? Well, PayPal has been executing massive aggressive share repurchases, which shrinks the total ordinary shares from 993 million down to 920 million. When you shrink the equity denominator, ROE mechanically goes up. On top of that, their debt-to-equity ratio sits at a highly elevated 60.7. So the crucial takeaway here is that high leverage and a shrinking share count are pumping this metric up. It's a massive reality check. Section 3, Strict Technical Indicator Checklist, the dashboard. Putting on my market technician hat, let's rapid fire through the exact metrics from the market agent's source logs. Price completely fell out of bed at 46.49. It broke the 10 EMA, registering a severe short-term momentum shock, and it lost the 50 SMA, completely breaking dynamic resistance. The 200 SMA is miles away at 58.82, meaning we are strictly in a long-term bearish regime. The MACD is positive but cooling incredibly fast, the RSI is weakened to 41.7 but not yet totally oversold, and the volume-weighted moving average confirms this was a decisive, volume-backed drop. The near-term recovery narrative is severely damaged across the board. And this brings us to a huge risk warning from the technical agent. The average true range, or ATR, expanded massively to 1.72. The exact trading implication here is critical for risk management. A volatility spike of this magnitude means you simply cannot use tight stops, or you will get whipsawed right out of your positions. To survive this market noise, the agents mandate that you must use wider stops, and because of that, you absolutely must size your positions much smaller than normal. Section 4, Bull versus Bears Synthesis Matrix. Now we structure the strict cross-examination between our two AI researchers. Championing the bull case, the analyst points to tremendous financial flexibility. $3.27 billion in free cash flow, structural ecosystem lock-in, and the firepower to fuel that EPS buyback accretion we talked about earlier. It's a highly profitable cash machine. But the bear researcher aggressively counterattacks using only the strict risks from the system logs, citing slower growth, intense margin pressure, that highly elevated 60.7 debt-to-equity leverage be flagged, the diminishing marginal utility of buybacks at premium prices, and the indisputable technical breakdown below the 50 and 200-day moving averages. It is a classic heavyweight bout between cash flow value and structural market weakness. Section 5. Deconstructing the agent debate. The war room.
Scanning the system logs, it is basically a war room in here. These two agents are in complete opposition. The aggressive analyst argues the drop to 46.49 is a momentum gift, an asymmetric turnaround entry point for a cash-generative machine that was punished unfairly. But the conservative analyst rigidly objects to that. To them, a cheap valuation offers absolutely zero capital protection during a severe technical breakdown below the 10, 50, and 200-day moving averages. To the conservative agent, buying momentum here is literally just catching a falling knife.
So, how does the AI resolve this debate? Enter the neutral analyst and the portfolio manager. They step in to reconcile the two extremes into a gradual setup. They acknowledge the stock isn't fundamentally broken, but agree the technical chart is ugly. They define this as a classic show me setup. The log quote says it all. It requires a measured hold with discipline. You keep your exposure modest. You do not add full size. You demand that the buyers step up and prove the thesis before you commit real capital. Section 6. Actionable Trade Execution Plan. The Blueprint. Here is the exact multi-tranche execution parameter list the simulation finalized. Step 1, the target price horizon rating is underweight over a 3 to 6 month period. Step 2, for positioning, you hold a starter or half-size position only and maybe layer on dips. Absolutely avoid initiating a full-size position here. Step 3 is the critical entry trigger. Traders must wait for a sustained reclaim of the 50-day moving average, specifically that 47 to 50 zone. And finally, step 4, the strict invalidation rule. Downside risk is heavily concentrated at the 45 support level. If 45 decisively fails, you must reassess immediately as it opens the trapdoor. Which leaves us with this final, provocative thought to take away from this explainer. The multi-agent simulation demands a strict wait-for-confirmation stance, completely refusing to buy just because the stock looks cheap on paper. Will PayPal's underlying cash generation and execution finally catch up to its valuation to trigger that 47 to 50 zone? Or is this a classic value trap where patience is the only thing that will save traders from a deeper drop? That's the billion-dollar question the AI leaves us to ponder. Thanks for joining me on this deep dive, and keep questioning the data.